Are you guys thinking about getting into missing middle development? Well, in today's video, Aaron and I are going to talk about all the different avenues and options you have available, whether it's uninsured, private construction, or CMHC financing. Stay tuned.
Hey guys, it's Aaron and Josh back with another Finance Friday, and today we just wanted to sit down with you guys and go over some of the things that we're seeing on the construction side. This is going to be some things with CMHC, lenders on the non-insured side, banks, alternative guys. Obviously there's a lot of changes going on in the market. We've had some CMHC policy changes with insurance premiums. The rental market's been going through quite the softening over the last probably even like 8 to 12 months, depending on who you talk to. So we just kind of wanted to give you guys an idea of what we're seeing from our side and from our insights, so that you guys can just take that back to your projects and just make sure you're moving ahead fully informed.
Yes, a little bit of a pulse check on the market. From a lending point of view, there's a little bit of cautious optimism. Cautious kind of highlighted and bolded. Lenders are still providing lots of capital for good borrowers in good locations where the numbers still work. There's no lack of liquidity or tightening of liquidity, let's say, for projects that aren't well capitalized and are not in great locations. So, money is still flowing, and there's still people who are making numbers work. And I think, what we're seeing is just, even with these increased densification laws in the city, 6 units as of right, still lots of people getting creative, pooling capital, making things happen. From a risk point of view, though, if you don't have liquidity and you don't have experience, it's becoming increasingly more difficult to be able to get conventional financing across the finish line for your first, let's say, construction project, or even on the private side. Sometimes, or most times, developers or investors will look to do their first project, but they want to build their first project. They don't want to cut that 30% piece or pound of flesh to a GC. And maybe back in the day when things were a little bit easier and rents were going up and they're a little not as soft, those projects could have got done on the private side. But even on the private side, we're seeing a little bit of pushback for experience or having a GC of the similar size and scope to help finish projects. So from like the lender side, underwriting's a little bit tighter. So putting together a stronger file, having access to more capital, and making sure that your numbers and T's are crossed and I's are dotted is gonna kind of get you across the finish line.
Yeah, I think it's no surprise to anyone that construction financing is kind of the topic right now, right? Missing middle has been huge for the last almost year now at this point, right? It's a very hot topic, consistent across all markets, Alberta, Ontario for sure, big conversation piece. And I think just, on top of some of the changes in the market, just the amount of new and mid-sized investors that are getting in and starting to get into the construction side, when you have, more volume of files coming across your desk, lenders just start to, become a little more risk averse and become a little more picky. So I think that's just kind of a normal pattern that we start to see. Like Josh was saying, obviously liquidity, experience are two of the biggest things a lender is going to take a look at. In terms of products out there for leverage, CMHC is obviously going to be your top tier financing, up to 95% of your cost. But what happens if you're not going to CMHC construction? Maybe your loan size is too small. Maybe with the insurance premium increase, you just don't want to go in through CMHC construction. Or maybe you want something that's a bit more flexible and a bit more time sensitive. You don't want to go through the timelines of CMHC. Whatever the reason is, you're moving to some sort of alternative lender, whether that's a credit union or one of these private guys. What are they looking at? So from a credit union standpoint, they are looking for the exit, obviously, still. Is it going into CMHC? Are those numbers going to be accurate on that takeout financing? Obviously on bank guys, credit unions, or a big five bank, they're still looking for liquidity. They're still looking for experience for sure, right? And that experience, they want to be as similar as possible to whatever type of building you're going to be constructing. So if you built wood stick townhomes and now you're looking to build a 10, 20 story concrete building, that that experience is just not going to fly. You're going to have to bring someone on that has experience with the concrete side and development management, all that stuff. Leverage wise, even though they are still underwriting with CMHC, the credit unions, more so specifically, are still safeguarding the takeout financing to an uninsured takeout. So even though they want to know what the exit is and they're still going to make sure the CMHC side is valid, they're going to underwrite it on their own template. So they're looking at a 30-year AM, 1.15, 1.2 debt servicing depending on the lender, but interest rates in the mid fives. And it's just not, the numbers just aren't coming out the same as what you're getting with some of the private guys and CMHC. Typically, we're seeing the financing fall anywhere around 65 up into a maximum of 75%. So for the mid-sized guys where the leverage or the liquidity is a bit more tight, it's a bit more of an issue, right? Most people are expecting 5-10% down, probably more on the 5% side, but when you get hit with a 35% equity bill, it's a bit of a tough thing to swallow, especially when most of the investor mindsets are, well, I'm going to go to CMHC, this credit union sends to CMHC, why can't we underwrite from that standpoint? And again, the lenders are looking at the risk side of it. They see that CMHCs they're making policy changes. They see the market softening. They just want to make sure, again, that worst case scenario, they're not going to get stuck holding the bag on a loan that just can't be taken into CMHC construction.
Yeah, and they call it the missing middle, but it's kind of funny, it's a missing middle at our end too, because there's a missing middle of finance. Like if you're sub $5 million, CMHC financing at like a phenomenal rate probably doesn't exist for you at the highest level. Like you're looking, when credit unions can provide you prime plus 1.5% with like a sub 1% or 1% lender fee, and you're trying to get a lender who usually doesn't do sub $5 million loans, you're probably not going to get any better financing from a terms-wise perspective, taking CMHC debt on the construction side. From a cost perspective. Now, obviously, the only advantage really is liquidity and equity. So, if you're taking your CMHC construction debt on these smaller loans, that 5%, I think we've reiterated this a million times, that 5% isn't actually the equity that you require. You gotta be able to show the 5% or the 25% with the bank, but now the banks are also want to see you have the 10% available for the holdback. So on $1 million deal, it's another $100,000 available to you. They also want to see, because you're going to have to hold the HST payments over the term of the loan, you're probably going to remit them every month or 2 months. They want to see you have liquidity to be able to access that, and then buffer liquidity on top of that. So when you're looking at an uninsured product and you're trying to make the numbers work, and even if the debt servicing works at 75% of the project cost, it's not 75%, it's 75% plus 10% plus a buffer, you're 35%-ish if you're trying to get this done with like a conventional bank. So we're having just a lot of conversations right now about leverage and the cost of taking on leverage, and it's kind of never been more true. The gap is widening to where, like, if you have a lot of capital right now, you can get phenomenal financing from a bank, but if you're kind of riding that line, it's just it's a little bit more costly to be able to get that higher leverage across the finish line.
Yeah, for sure. And the lenders are looking at everything, right? And across the board too. I mean, CMHC or non-CMHC, they're taking a look at the economy, what's going on in the rental market, and the rents are softening. They are down, and everyone's aware of that, right? It's taking longer to get your tenants into the building. I was just talking to a construction guy this morning, and he said even out in Alberta where buildings were getting filled up within a month, he's like, we're seeing them take 3-4 months now to be able to get these buildings fully occupied. So we are in the bottom cycle of the rental market. I mean, we're coming off like extreme highs, obviously, but in today's market and when we're underwriting the deals, like, yes, things are down, and it is trending that way for now. What does that mean for your projects moving forwards? Well, lenders across the board, whether it's CMHC or not, are starting to factor in the rental softening. I've had a few deals out in Alberta where we were submitting with more top end market rents, and the lenders just looked at it and said, hey, this isn't what we're seeing in this market. We're $150, $200 less than what they have here on the projection, and that's how we're going to underwrite the deal, both on the qualification and then translating over into your as completed value on the project as well too. So they are actively implementing these changes depending on how prominent it is in your neighborhood. And even on CMHC standpoint, if you're submitting with a rent, first off, if you're submitting with rents way above where market normals are, CMHC is going to bring those rents back down. So if market normals are $2,400 and you're at $3,000, CMHC is not going to give you that rent. CMHC is also starting to make changes on rents that they're seeing trend downwards. So if you're projecting up $2,400 in an area, and what they're seeing on projects that are being submitted in their own rental survey data, and they're at $2,200, you know, they're bringing those rents back down because again, they're not going to take that added risk in a market where they know that the rental rates are declining, and they're factoring into that decision making.
Yeah, and I mean, on top of, you know, softening rents, you know, I mean, Debbie Downer, but also vacancy rates. You know, you're taking a look at real-time vacancy rates, and that's affecting, you know, your effective gross income when you're underwriting the debt. So, you know, we have files that we've underwritten, let's say 12 months ago, and you're going to go to, you know, takeout financing with CMHC, and you have softening rents, you have increase in vacancy. And you know that plays into total NOI and like your actual serviceable debt at the end of the project. But not only the serviceable debt, but the as complete value as well. If you're $200 off every single lease that you have, that has a direct impact on your net operating income, and thus, you know, your cap rate and your value. Cap rates are expanding. I've had multiple conversations over the last few days with you know, appraisers. You know, you're taking a look at appraisals that were done 12, 18 months ago when you're projecting out projects, and they were using, you know, data that was real at the time, but the data that's coming in now can't support the as complete value anymore. So, you know, if you're in the middle of a project, rerunning your numbers, just understanding how that's going to impact maybe your equity position at the end of a project. Essentially every single aspect of the market, whether it's bond yields or, you know, softening rents or vacancy rates, they're all just inching your equity position forward at the end of the project. You know, we are still seeing people, you know, make numbers work. You know, they definitely absolutely are still working, but you know, there are a handful of factors right now that are affecting overall qualification, especially takeout with CMHC.
Yeah, and I think just jumping back to like the leverage side of it as well too, the alternative like private sides are a bit more competitive. You know, we still are seeing, like I had some term sheets issued this morning, 80% loan to cost. You know, a lot of these A-plex stuff in Alberta, you can still get to that 80%. Depending on the project. You're not going to get that on the credit union side. The private guys seem to be one of the few non-CMHC insured type products where they're really still just focusing on the actual CMHC exit, and that's allowing them to get that higher leverage. Yeah, you know, there's a bit more of a cost, your rate's a bit higher, your fees are a little bit more higher, but you know, the turnaround time is quick. Your tranche times are, you know, within 72 hours after you have your, you know, your invoices submitted. So, you know, those still are, like, there is still some benefit of going to that private side. It is a bit more competitive as well too. So again, you know, if you're looking for the leverage, like, don't be, you know, surprised when you end up in a, you know, potentially into an alternative type lender if CMHC is not kind of your cup of tea moving forward.
Yeah, no, absolutely. I think that, you know, submitting for, you know, your CMHC, you know, financing, you know, if you're still above that $10 million mark, it still really is the play. You know, the leverage in the debt service coverage ratio, as well as the increased amortization, can offset a lot of the impact. You know, you don't have as much cushion when you have like a 25-year AM and 1.2 debt service. You know, one of the advantages though, if you're looking at like alternative underwriting options or uninsured options for the takeout, you know, the uninsured options don't factor in additional CMHC benchmark expenses. You know, not all credit unions or banks will do that, so you might actually have, you know, a slight benefit, not necessarily, you know, getting hit as hard because you're not factoring in salaries or, you know, replacement reserves or whatnot. Some big credit unions do, but not all of them.
Yeah, and I mean, like in regards to the rental softening too, like, it's not to say that you still can't get the rents that you're projecting. It's really just the lenders putting in, you know, risk limiters. If they see the market softening, they're going to account for that. If you have a great team, you know, a great realtor, you know, whoever it is that's in charge of leasing out your property management, whatever, like, it's not to say that you still can't get these rents. It's just the lenders are taking their own precautions. And it's also not to say that CMHC, like, you know, Josh was saying, like, if your loan's going to qualify, you know, not to say that CMHC is still not a great option. It is going to be your cheapest option moving forward in terms of your costs and your fees. It's really just a preference. Some people don't mind moving ahead with CMHC construction. Some like the flexibility and just the quickness of non-CMHC. Again, even if you build non-CMHC, you can do construction takeout with CMHC. Now that the premiums have changed, you do get a bit of a cheaper premium than building directly with CMHC, and we have some people, you know, take that route. But again, like, CMHC at the end of the day is going to be the end of, you know, your term financing choice for sure, whether or not you take CMHC construction. So again, just because a lender, you know, comes out and says rental market softening, definitely something to keep in mind for sure when you're projecting your rents. And trying to make sure you're using rents as of today and not where rents were, 6, 7, 8 months ago. But just, don't overly panic. Again, do your due diligence, talk to your team, your property management staff, what are they seeing in the area, and just making sure those numbers seem like they're going to be able to come in, because again, just because the lender said it's softening doesn't mean you're not going to get those rents. It's just, it is hitting the market.
Yeah, I think without a doubt, where policy is going, we are going to continue to see this mid-market infill construction development. I think a lot of the people, our listeners or viewers who were purchasing multifamily before, if you're not, most are trying to transition into this type of investment. It is a little bit more complex, does take a little bit more capital, and there are a handful of different avenues in which you can go down. But without a doubt, this is probably the next phase in which retail investment moves into an infinitely scalable investment solution. You can find phenomenal financing at the end of the project, and really it comes down to how much capital you have, how much flexibility you want, how fast you want to do it, location. If you guys are looking to dive into, mid-market projects, whether it's semi-detached fourplexes, triplexes, ADUs, we're digging into all those types of projects all across the country. We are actually, if you guys are going to listen to our podcast, we're actually have a few guests on that are going to be specifically talking about the Toronto rezoning and what that looks like for 6 units as of right. So. Really looking forward to digging more into that. If you guys like this video, please hit the subscribe button, hit the like button. It allows Aaron and myself to make more content like this for you. Appreciate you guys listening.